Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Investors are partying like it's 1999. Investors in Oracle, that is. And that's because the last time the stock rallied this much was 1999. Stock is up, as John just said, nearly 40%.
You weren't even alive back then, the two of you.
Oh, go on.
We remember the dot-com bubble days.
Oh, never mind.
So I want to bring in Anurag Rana now, Bloomberg Intelligence technology analyst. He was around in 1999, coming to us from our Chicago bureau. Okay, so we know that, it was a blowout quarter, AI just driving things there. But I want to talk a little bit about traditional software, which is what this company is all about, and the fact that that's not really working at Oracle, but it doesn't seem like investors care today, Anurag.
Yeah, so Oracle's a very unique company because it has your traditional software, but also a few years ago, it started a cloud business called Oracle Cloud Infrastructure, something very similar to what AWS does or Microsoft Azure. And one of the advantages it has is it just rents out its, servers for people to go out and train their AI models or run their applications on it. So this is really a new business for them, just came up the last few years. And that's where the biggest growth is. And that's what's driving the stock.
That's what's driving the stock. And that's probably where Oracle is driving its spending as well. What's happening with the rest of the company? Its operations, its software business, is it still cutting costs, for instance, and reducing headcount?
Yeah, I think you're absolutely right about it. So the advantage Oracle has compared to, let's say, a company like CoreWeave or Nebius is that it has a very high margin database business and very high margin application business. These businesses have gross margins, let's say north of 90%. Now, when you marry that with a massive AI infrastructure business where you need to spend a lot of money, that's problematic for somebody that doesn't have that. But Oracle has that luxury that it can spend billions of dollars. Before yesterday, we were thinking they're going to spend, somewhere in the low 30 billion range, which was already higher than what they had guided and, even the street was expecting. They came out and said they're going to spend over 35 billion in the next financial year. So that's a lot of money going into expanding data center, buying chips, creating a new infrastructure to fulfill this demand.
Also, we should note that a number of analysts are raising the price target on Oracle. TD Cowen caught my eye, raising the target to $375 from $325 a share. But when you look at the competition here, Microsoft, Amazon, Alphabet, what does Oracle, or how does Oracle differentiate itself, not only for the customer, the client, but for investors?
Yeah, and one of the things I would say is everybody is having a good time in this particular party. It's not just, one company that's gaining it. It's just the size of their business is far smaller than it is for, let's say, AWS or Microsoft. In the last financial year, their revenue was, roughly about 10 billion or so. AWS's run rate is like 125 billion. Microsoft's business is 75 billion. Google's business is 50 billion. So please, you're going to take that with the context of how big Oracle's cloud infrastructure is compared to some of the bigger vendors out there.
Anurag, it feels like Oracle kind of came from out of nowhere with its contributions to the AI space and being such a big player. Certainly the bookings of almost $500 billion caught my eye, and it's more than 4 times what it was the same time last year. Are there any other kind of dark horses out there that you would be keeping your eye on that could be the next Oracle, which already feels like it's the next NVIDIA?
Yeah, I think one of the things you have to think about it is it's not easy to come up with this structure or a business like this because you need billions of dollars to create a data center or to lease out a data center, then buy equipment like NVIDIA chips and computing equipment. There are a handful of companies like, CoreWeave or Nebius, which are smaller neo-cloud players that specialize in renting NVIDIA GPUs to customers. Now, the bigger vendors have the capital that they are also expanding it. But again, as I said, given the size of the increment that they are seeing, you're not getting that same growth rate.
Do you think there's a little over exuberance, though, in the market today with Oracle's stock up nearly 40%, especially with so much talk about whether or not we are in an AI bubble and what happens if it starts to deflate?
Yeah, see, one of the things you have to remember is for Oracle at least, they have this backlog of orders coming in. And it's coming, for example, one of their biggest customers right now is OpenAI. If OpenAI continues to expand revenue at a good pace over the next several years, they are going to be spending a lot of money to train their models in order to stay ahead. So I think there is a lot of relationship over there. If let's say you and I don't use ChatGPT as much, that would have an impact on OpenAI's revenue. That would have impact downstream revenue on all the other players, whether that's NVIDIA or Oracle. But frankly speaking, we are not there yet.
I'm looking at the Mag 7 members and how they're performing today. NVIDIA is up almost 5%. Amazon down 1.9%. Alphabet, which is the parent of Google, up marginally, up 0.1%. And Microsoft getting 0.6%. It doesn't feel like this is a situation where it's a zero-sum game. Oracle wins and Microsoft, Google, and Amazon lose. Or is it?
No, so there are a few companies that fall into this bucket, and those include Amazon Web Services, Microsoft, Google Cloud, CoreWeave, Oracle, and Nebius, for example. So these are the ones that are seeing extra spending right now. But when you look at on the application side, whether that's Salesforce or Workday, those guys are not seeing that benefit because they're not in that infrastructure game. So there's a huge difference between the two vendors or between the two category of vendors. Right now, we are more in the build phase of AI, not the implementation phase of AI.
It's hard to believe, Scarlet, but this stock is now worth more than, has a larger market cap than Walmart, Eli Lilly, JP Morgan Chase.
Yeah, that is pretty remarkable. And again, it feels like it kind of came from out of nowhere.
You're right on that.
Very recently.
Which is why I brought up, Amazon, Microsoft, right, Anurag? I mean, the fact that those were the names we were really talking about when it came to AI. And then sort of Oracle comes out of the blue.
Yeah, but that's the whole point. This particular infrastructure, if you're going to run large models, it's very unlikely you're going to do it in-house. I mean, you can do it, but you require a lot of investment going in. You're better off renting out data center capacity or computing capacity from one of the cloud vendors. And Oracle has the money to spend it. And they have the relationship with NVIDIA to get those GPUs. And on top of that, they are offering this to customers and saying, here's my equipment, come and test it out the way you like it. Amazon, on the other hand, for example, sells it as a package. And that's where you're seeing some distinction and also the size, as I mentioned before.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're keeping an eye on Novo Nordisk, the drug maker. Remember, they are the company behind Ozempic and Wegovy, has decided to cut 9,000 jobs and also cut its profit forecast as well. So let's bring in Sam Fazeli. He is Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals, our go-to guy for all things on global drug makers. And Sam, for Novo Nordisk, this is part of a broader restructuring that the new CEO is undertaking. Can you tell us a little bit more about the changes taking place?
Yeah, sure. And very nice to see you again all. So the story here is that this is not the first time they've lowered guidance for the year. I mean, this time there's an impact on the EPS front from obviously the costs of restructuring, assuming they can get it all done this year. But it's a pretty chunky one, 9,000 people, about 11% of the workforce, and a lot of that coming from Denmark. If you read the essence of the press release that they put out, there's a couple of things that they bring out. They want to invest more on R&D. Well, what I think this is telling you is that the growth that they had planned for the next 5 years, they may be thinking maybe that won't come as fast as we were expecting it because of competition from Lilly, compounders, and other products potentially coming to market to the pace that they were hoping. So if you want to keep investing in R&D, you need to liberate some cash. And also, it looks like that they're also thinking about changing the way that they're doing their marketing because of the different channels that they're getting involved with now, direct to consumer. That is not something that pharma has done very often before. In fact, only Lilly had done it prior to this, also for an obesity drug. So maybe the costs of that are different. And there's an element that they've referred to in there, which is a culture of performance-related reward. And you think to yourself, well, what was it before? So it seems like that they want to make it much harder focus on you've got to deliver because we need the growth. So that's interesting all to watch.
Sam, I think to a lot of casual investors who don't deep dive into, Novo Nordisk the way you might say, would look at this and say, listen, they have the most popular weight loss drugs, right? Wegovy, Ozempic. Why is this company having these problems? When you drill down, or is it just a problem with having to scale too quickly? Is it that the company isn't nimble enough to sort of change with the times?
Well, Novo Nordisk has been a poster child of how you grow from a small company selling to a relatively basic set of products 20, 30 years ago to one that's become essentially one of the innovators in the space. They brought the first GLP-1 to market. So we can't fault them for that. It's just that I think this growth that they had to go through, where the planning was done, we have $100 billion market potential for obesity as a whole, right? So it's just difficult, I think, to judge into this space. And maybe the previous CEO had looked and said, I'm pretty sure we're going to be 50% of that market. We need to plan for that growth. And then two things changed. Competition from Lilly is super intense. They have what I would call a better drug in terms of the efficacy profile that's been shown in head-to-head trials. And then, of course, you've got on top of that compounders that don't seem to be going away. They keep taking cheaper generics, or not generics, manufactured elsewhere and making the drugs. So that's where I think the new area issue is, in that we all expected the FDA to really clamp hard down on that, and they haven't.
Right.
They've made issue, statements, but they're allowing them. They even found areas outside the U.S. where these compounders can get their drugs from, which is counterintuitive. So those are the issues.
Yeah. So it feels like Novo Nordisk gave up its first mover advantage, but has it lost its lead completely in the U.S. obesity market to Eli Lilly permanently, or is this still very much a wide open contest?
No, I can't remember what the latest number is in terms of what percentage of people who would benefit from these drugs, who should be able to get them, are on it, but it's not in the big percentages. I'm pretty sure it's in the single-digit percentages. So there's a lot of room to play for. I think our estimate, and I hope I'm not completely off on this, was about 189 million people could be on these drugs by 2030. That's enormous. There's lots of other people coming with orals, with other things. It's not a matter of having lost the lead. Yes, Lilly surprised with a slightly different mechanism, still the same, but with a better drug. There's still room for innovation here, which is what the company's saying. We need to save to keep investing in that innovation. So that's the area I think that they're highly focused on now.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
It's a tough day for investors in Synopsys. The chip design software provider missed Wall Street's estimates, hurt by weakness in its design IP business. I want to bring in Niraj Patel now, Bloomberg Intelligence senior software analyst, for more on this. So give us the larger story behind this disappointment, I think is an easy word to use for this. I don't know. I feel
it's
like
fair.
Investors, yeah, right? All right. Niraj, what's your take?
Yeah, this is a major shock to the investor community, and I think you see it in the stock price. Specifically, the company's design IP business, that's about 30% of sales. It has been growing 15% annually, and they're a leader in a subcategory called interface IP. This business now is going flat. It was tracking to about 15% growth as of 2Q, and the remaining 2 quarters are a big shock. This quarter, it was down 9%. Next quarter, it's going to be down some more. And this catalyst came out of the blue, I would say, for a lot of the investor community, because design IP has a lot of tailwinds related to AI, complex chip design, as well as all this advanced architecture that the semiconductor design companies like NVIDIA, Broadcom, Intel are pursuing.
So can we blame, or can the company blame, factors beyond its control? And here I'm referring, of course, to trade war, tariffs, for that? Or is this something that Synopsys just wasn't prepared for?
Yeah, there's a lot of interesting points there, Scarlet. And I think when we're looking at trade war, yes, a little bit of an issue. And the China EDA ban that initiated end of May, that lasted about 6 weeks. That was introduced by the Bureau of Industry and Security in the US. But their major peer, Cadence, and competitor, which is second in market share, they reported several weeks ago they had the same macro issues and they actually tuned up their guidance. So this may be a little more company specific than macro factors. And I think what's hinting us that they made big investments to catch up Intel Foundry in relative to some of the other competing foundries with their IP. And this hasn't returned any type of scale on the revenue side for them. And this reality really hit them this quarter and for the next several quarters.
So did the CEO, Ghazi, say anything on that post-earnings call to give investors a little light at the end of the tunnel here, an indication of how they're going to turn things around at Synopsys?
Yeah, I think it was a little murky in terms of the numbers. They closed a mega deal with Ansys. That was about $35 billion in mid-July. This should have added about $600 million in total revenue. So the numbers didn't add up to their guidance of $7 billion. So a little light in terms of adding this acquisition that closed. So that's going to be a little bit of a digestion period, we think. And it's going to take several quarters for the investor community to settle in. And I think, we're facing this issue where they have a lot of AI-related tailwinds. You're building more complicated chips. You're using a lot more interface IP for these chips, and they're the market leader in this market. So things aren't adding up, I guess, when we look at, the story and the narrative that they've communicated over the last several quarters, the AI story that we're hearing from NVIDIA and Broadcom, and some of the investments that are occurring across the ecosystem.
So very quickly here, is there any good news in this report at all? Is there anything to hang your hat on if you are a long-term investor and you don't want to give up yet?
Yeah, I think this space is an oligopoly. Cadence and Synopsys, there's no new entrants. Competitive price pressure is very low. There's no substitute for technology. You have to use their tools to design chips. And the more advanced the chips get, the more features you introduce. You introduce a lot of verification and sign-off steps to make sure all the electrical characteristics are working. You're not generating too much heat. You have mechanical structures. So you have to use their IP. You have to use their EDA, electronic design automation tools. They're 35% share. Cadence is at 32% share. And you have Siemens at about 16%. So you don't have a lot of alternatives here. And once you build on any of these platforms, it's very hard to switch because your engineers are used to the type of data and the type of tool sets and the type of bugs that they produce and going through their workflow.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I am taking a look at Chewy right now, the online pet supply retailer, taking it on the chin today. Profit falling in its fiscal second quarter, and that's despite an uptick in sales. The company did add more customers last quarter. Let's break this down, though, with Diana Rosero Pena, Bloomberg Intelligence's consumer staples analyst. So, Diana, tell me, this looks like a mixed quarterly report from Chewy. What has gotten investors so hot and bothered here?
Yes, I think what investors were trying to see in this report was that there was an inflection point in the industry. And I don't necessarily think that they have found it in this report. Sales was higher than the the investors expected, but margin guidance, EBITDA guidance was kept. And that was a little bit of bad news for the company and the industry as a whole.
Talk to me about innovating in this industry, because I would think that if you just stop innovating, that's when you start to have the problems. Is that starting to happen with Chewy? It is a leader in this space, but does it need to still be one step ahead of the curve and innovate here?
Well, yes. And I think that is one of the things that they were trying to communicate during their earnings call. They are actually investing, and that is going to probably offset some margin momentum going forward, at least the second half of the year. They have vet offices now in 4 states.
That's right. I've seen that.
Yes, exactly. They actually launched Chewy Plus, which is a membership program, and apparently has been very successful. And also they have launched private brands with Get Real, which is a fresh frozen dog food brand.
So the company also added a pretty decent amount of active customers, right? 150,000 on a sequential basis. So now its total customer base is nearly 21 million. How much more room is there, do you think, to grow? Because we know people will spend big on their pets.
Yes. And what we're seeing is probably going to see a greater contribution on the pricing side compared to the customer base. And that, again, that's another reason. While they did show positive momentum on customer base, it was still, in the mid-single digits, which is not necessarily significant growth or growth that they had seen before. So, we still see an equal contribution for the customer base, but it's not necessarily as impressive as it was years before.
I'm curious if they talked at all on the post-earnings call about tariffs and how that might be impacting. I would imagine a number of their products are coming from overseas, China in particular, when you're talking about some of these pet toys as well.
Yes, and they did not quantify the hit that it was going to be on cost of goods sold, but they have mentioned that private label, their private brands are significantly affected by tariffs. And that is one of the reasons they probably held margin guidance for the year, because they said that they're going to invest in pricing and be more competitive.
Who does Chewy see as their biggest competitor?
I would say Amazon and also brick and mortar retailers like PetSmart and Petco.
And so what about the horizon? I mean, I don't know how far they went out, but what are projections? What kind of guidance are they offering investors?
So they only have noted the annual guidance. They don't necessarily want to speculate on other things, but they still think that there's a lot of momentum in the industry, and I think investors are not necessarily that they do not agree on the long-term potential, but they're more worried about what the 6 months are going to bring, the next 6 months.
Yeah, and in terms of profit, what was the pressure on profit? They said it was tied to share-based compensation. There were also some related tax issues. Can you just tell us a little bit more about that?
Yes, that was another thing, and what they mentioned. There was, margins grew, and it was gross margin was up 90 basis points year over year, but they mentioned that was going to be the high point of
so
that
trying
metric.
To manage expectations.
Exactly,
right.
And that is what the investor community was honing in.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.